and this is our group members.
Good morning. Today I will be discussing working capital, its definition, importance, and finally elaborating the objective in a clearer and slightly more detailed way. So first, we start with the definition of working capital. Working capital refers to the difference between company current assets such as cash, inventory, and account receivable, and its current liabilities such as account payable and short-term debts. It indicates company liquidity and short-term financial health. So working capital formula can be referred as current asset minus current liability. So the next was the objective. The main objective of working capital management is to ensure that the business has enough liquidity to run its daily operation without interruptions. This means having a sufficient funds to cover all short-term expenses such as paying suppliers, wages, and utility bills. At the same time, the business aims to minimize the cost of capital so that it does not tie up too much money in a current assets, which could reduce overall profitability. Finally, an effective working capital strategy seeks to maximize efficiency and earnings by balancing cash, inventory, and receivable in a way that supports smooth operation while also generating the best possible returns. Moving on, we go to the importance of the working capital. First, liquidity management. Ensure the business can meet short-term obligation and avoid cash shortage. Second was smooth operations. Help maintain continuous production and sales by providing funds for purchasing raw material and paying operational expenses. Third one for the importance is profitability. Efficient working capital management minimize costs and maximize return on current assets. And the last one was credit worthiness. Adequate working capital improve a firm's credit position and reputation among suppliers and lenders.
This slide explains how assets and liabilities are categorized in financial data analysis for company that we choose, which is Shell. Assets and liabilities are divided into two groups, which is current and non-current. Current assets are items that a company expects to convert into cash within 1 year. It includes inventories, trade and other receivables, derivative financial instruments, and last, cash and cash equivalents. Next, non-current assets are long-term resources used for more than 1 year. This includes goodwill, other intangible assets, property, plant and equipment, joint ventures and associates, investment in securities, deferred tax, retirement benefits, trade and other receivable, and last, derivative financial instruments. Current liabilities are debt, trade and other payables, derivative financial instruments, income tax payable, and last, decommissioning and other provisions. Non-current liabilities are long-term obligations such as debt, trade and other payables, derivative financial instruments, deferred tax, retirement benefits, and decommissioning and other provisions. This slide explains the difference between permanent and temporary current assets. Permanent current assets are minimum level of current assets that business must always keep to operate smoothly. Examples include minimum cash and cash equivalents, trade and other receivables, and inventories. Temporary current assets, on the other hand, are additional assets that fluctuate with business activity. This includes extra cash and cash equivalents, trade and other receivables, inventories, and derivative financial instruments. In simple words, permanent assets are always needed, while temporary assets rise and fall with business demand.
Next, for the calculations of net working capital, we will use the formula current assets minus current liabilities to solve. Based on the calculations, our net working capital decreased from 2023 to 2024, where in 2023, the net working capital has 38,004, but in 2034, it dropped to 29,238. This shows that the company has weaker short-term liquidity in 2034 compared to 2023. The decline mainly happened because the company's current asset went down, especially from lower trade receivables, inventories, and derivative assets. Even though the company successfully reduced its current liabilities, the drop in current asset was much bigger. This means that the company has less room to cover its short-term obligations, which could affect the day-to-day operations if the trend continues. Next, I will explain the financing sources used for both fixed assets and current assets. For the non-current or fixed assets, which total 259,683, the company mainly used equity amounting to 180,168 and long-term debt of 112,407. This makes sense because fixed assets provide long-term benefits, so they should be financed using long-term sources. Meanwhile, for the current assets, which amount to 118,069, these are mostly financed using short-term liabilities, such as trade payables and short-term debt, totaling of 95,034. Part of the long-term funds is also used to support the current assets. This is normal because current assets need flexible financings that can be repaid quickly. So, overall, the company follows the matching principle, which is long-term funds for long-term assets and short-term funds for short-term assets. What interesting is that the company is actually using some long-term funds to support the current assets. This can be seen as a conservative financing strategy because long-term funds are more stable and reduce liquidity risk.
Working capital policy refers to how a company manages its current asset and current liabilities in order to maintain liquidity while maximizing profitability. There are generally three types of working capital policy. It is relaxed, moderate, and restricted as shown in the graph on the slide. So first, Shell has $180,069 million in current assets. This shows the company has high liquidity, meaning they have enough short-term resources to cover their needs. Next, their current liabilities are $88,831 million, which is considered as a moderate debt. Then, we subtract both values. We get a positive net working capital of $29,238 million. This simply means Shell has more current assets than short-term debts, so the company is in a safe financial position. Then, we look at the current ratio. We divided current asset with current liabilities and it is equals to 1.33. A ratio around 1.3 indicates a moderate working capital policy. It is not too aggressive and not too conservative. It is a balanced approach.
Financing strategy. Shell record 112.4 million USD in long-term liability and only 88.8 million USD in current liability, showing a heavy reliance on long-term financing. It shows that a shell company use conservative strategy in their system financing. A conservative strategy would focus on stable long-term capital structures to ensure it can comfortably meet both its short-term debt obligations and its massive future liabilities over many decades. This diagram shows the conservative financing strategy, where a company relies mainly on long-term financing to fund both fixed asset and permanent current asset. Short-term debt is kept at zero or at minimum. Any excess funds are kept in marketable securities for safety. This indicates that Shell prioritize long-term financial security, and strong liquidity. which are the key features of a conservative strategy. So, from both the diagram and Shell's data, we can confidently conclude that Shell applies a conservative current asset financing strategy.
For the conclusion, the analysis of Shell's statement of financial position indicates that the company takes a deliberate and structured approach to managing its working capital. The financial ratio calculated, including a current ratio of 1.23 and net working capital of $29.238 million. This suggests that Shell operates under a moderate working capital policy while adopting a conservative strategy for financing its current assets. This conservative stance is consistent with research indicating that firms with higher working capital level tend to experience reduced market risk and greater financial stability.